In this video, I'm going to go through the Q2 earnings call for CloudMD. This is in the year 2022. They are DOC on the Toronto Venture Exchange. I took all my notes from the Q2 earnings and organized them in a chronological fashion. So what's happened in Q2 that I wanted to highlight, not going through all the numbers because you can read all those yourself. What did they say about Q3, Q4, and the future, particularly Q1 and Q2 of next year. And then I'll end with sort of my numbers and what I think of the future going forward. And you'll see it's a little hard to model the numbers for next year right now until we get a little more clarity on their divestitures and what happens with Vision Pros. So first, some details that I viewed important from Q2. Enterprise Health Services is going to be their most important division going forward. So they saw a revenue drop from 26 million in Q1. It dropped 1.5 million in Q2. They talked a lot about COVID testing contracts rolling off and contracts with the Ontario government to allow mental health services without any barriers or doctor referrals needed. And they're just thought with COVID transitioning, they're not going to have that type of revenue in the future. So there was a $3.2 million drop in COVID contracts. Now their enterprise health services revenue dropped by less than that, so we must be seeing some reasonable organic growth in that division. They kept talking about, both in the prepared remarks and the Q&A, seeing low double-digit growth in this unit with larger and larger contracts being signed. So that was really good news. In the Q&A, they talked about the cash burn, removing non-recurring items. And it's about $6 million that they're going through in a quarter, and they're going to have to get that down to zero, hopefully by Q2 next year, when they hope they might be cash flow positive, or cash flow positive at the earliest. In Q2, Vision Pro's US sales did start again at the very end of the month, so at least that business is starting to grow again. I wanted to end my little bit about Q2 by looking at the three divisions. So Enterprise Health Services was 24.5 million, the Digital Health Services, which would have Vision Pros in it, 6.2 million, and then clinics and pharmacies, a little under 10 million. I wanted to break this out because they talked about divesting the clinics and pharmacy business. So I really wanted to dive into exactly what type of revenue drop that could mean. So in the future, I'm kind of X-naying that revenue in my future models. Looking into the future, and again assimilating all the comments from the prepared remarks and the Q&A, they have found about $4 million per year in cost savings that will start this quarter, so about $1 million a quarter. Selling some non-core assets, the clinics and pharmacies, the brick and mortar business. They started this process 45 days ago, so they're well into it, and said they will have some updates in the coming weeks. The exact wording was several weeks that was used in the Q&A. So several, maybe 2-3 weeks, hopefully we'll hear something. The CFO talked about the revenue drop from Ontario contracts in the upcoming quarter, so it's 1.5 million in Q3 and 2.5 million in Q4. They will receive a little over 3 million from the Vision Pro settlement, or they have that money already, but it's Q3 time frame, not Q2. They'll have a full quarter of US Vision Pro sales this quarter. And one of the most important things I got from the call in the Q&A, the CFO sort of gave a similar revenue number for Q3 as Q2. So I thought it was nice to get a bit of a good forward guidance and where they'd be with all these contracts rolling off, new contracts, Vision Pro changes. So the organic growth of the company will hopefully balance the contract losses or contracts that are rolling over. And the very last comment on the whole call, which I liked, was that the CEO is looking forward to more frequent updates. So that'll be nice. There's been a lot of, obviously, CEO change. So the new CEO will get us back to some more frequent news. As far as cash goes in Q3, particularly with inflation raising rates, potentially being very hard to raise money if we go into recession, looking at your burn rate and cash is important. So they have about 30 million of cash at the end of Q2. They got in Q3 that $3 million settlement. So that puts them a bit over $30 million in cash, which gives a reasonable buffer, well over a year at their current burn rate. And then we have these divestitures. So I'm trying to make a bit of a rough guess at what might be coming in here. So they're making over $9 million a quarter from clinics and pharmacies. They said they had a 20% gross margin. So 36 to 40-ish million a year. Trying to make a crude guess, if you use 2 times sales, you're kind of in the $70 to $80 million range that they could potentially get from these clinic and pharmacy sales. Even if they only get half this, they got 40 million. That's really going to shore up the balance sheet. And regardless of a recession, what happens, as long as their burn rate keeps coming down and they build the business, they should be in good shape going into the future. In Q4, as mentioned earlier, they're going to have this 2.5 to 2.75 drop in Ontario government contract revenue. But all the Q2 announcements they've made about new enterprise health services contracts will be fully online. That was confirmed in the Q&A portion of the call. And the CFO believes that revenue will increase compared to Q2 numbers in Q4. So the company will be back into a growth phase. If this company isn't growing, then I certainly, and you hopefully, don't want to invest in it. So that's important. The Vision Pro ramp up is going to be a bit slow. It'll be larger in Q4, but the Q&A session talked about really wanting to keep customer acquisition costs low, so they're not going to be ramping up to where they were before really fast. They want to maintain their margins. So when they bought the company, it was doing about $22 million per year, Vision Pros was. So we're not going to be back to that super fast. I'm really not sure how long, and that's one of the things I'm finding difficult to model in next year's earnings of what does Vision Pros look like. I don't know if there's any way to really know. So going forward, so they have organic growth of 10+%. I was really disheartened a few quarters ago when previous CFO talked about growth being way under 10%. I was really considering dumping my shares. So this growth is probably is a necessity for me to be an investor. It was mentioned that 30% of their top 100 customers are getting multiple products, so they're selling not just to new customers, but to their current ones with a fairly large degree of success. As mentioned earlier, they've got this 4 million of new contracts signed in Q2 that's fully on stream by Q4. The deals are growing. Their work with Sun Life seems to be paying dividends. They talked about month-over-month sort of growth through that collaboration. They will not be cash flow positive before Q2 2023, according to the CFO, so that's kind of an earliest date. So that'll be a very important milestone when they get there. If they can be cash flow positive and growing 10% a year, that seems enticing to me as long as the price is right. Towards the end of the call, there was a concern about cash flow and EBITDA becoming positive with the divestitures. But it was mentioned that the clinics, pharmacies gross margin is only about 20% lower than the rest of the business, and it doesn't contribute much in terms of EBITDA, so there won't be any concerns about reaching their targets and reaching EBITDA profitability, even or depending on what they do sell. So the 2023 financials, hopefully we're going to watch this burn rate go from 6 million down to 0 in Q2. Things sort of rarely happen as fast as people want or say, so maybe it's Q3 before they get there. And the CEO really talked about the vision of the company towards the end of the call, and she views it as a recurring revenue business into the future, so not a whole bunch of fee for service, or you go and see a doctor once and then they're going to bill fee for service, but it's going to be recurring revenue enterprise health services type contracts with through companies providing EAP to their workers. She viewed, I was a little surprised, viewed less than 5% of the business being fee for service, so that would be a pretty small number, and you can really sort of model off this recurring revenue side. There wouldn't be that much room for error if you're only worried about a 5% fee for service. Even if you're off by 10% in that small 5% bucket, it's not going to affect anything. So easier to kind of predict the future. So these are my own personal numbers. We're leaving behind anything I saw on the conference call. So Q1 and Q2 are in the books. This is at 40.3 that they just announced. And I've broken my predictions between enterprise health services, digital health services, which would contain Vision Pros, and clinics and pharmacies. So they mentioned that Q3 will be about the same. So I kind of, in my model, kept the same clinic and pharmacy number in both Q2 and Q3. Digital health services, these are definitely a guess. Vision Pros will be growing. Q3 is the first full quarter in the US. Their $22 million run rate for Vision Pros when they bought it, or 5 and a bit a quarter, who knows when that's going to come back. So I'm kind of just putting little bits of it back, and I need to see a few quarters. So I'm adding some decent jumps, and then sort of half-ish $1 million per quarter coming back. Enterprise health services, we've got that 1.5 million drop in Q2 and 2.5 to 2.75 in Q4 versus 1.5 in Q3 from Ontario contracts. So that's why I have that dipping, and then I have it growing at 3% per quarter next year. So that's a 12 and a bit annual growth rate. So coming from their low double-digit growth rate. So that's where enterprise got my line, some dips, guesstimating the organic growth, and then consistent growth. I'm choosing in my model to totally eliminate clinics and pharmacies. We'll see what happens and what gets sold. But if you totally eliminate the clinics and pharmacies, use hopefully conservative numbers for Vision Pro's ramp up, I end up getting a price to sales ratio of about 0.8. So I use their market cap, which is about 110 million right now at 36.5 cents per share. And then I use just the earnings that I've circled in purple, so no clinic and pharmacies. I get that 0.8 ratio, the 110 divided by what the purple bit adds up to. So that is mildly compelling. If the growth rate nosedives to 0, well, then it's not compelling. But if a company is growing, more than 10%, they can hit EBITDA positive next year, cash flow positive, reasonable amount of cash, somewhere between 30 and 100 million, depending what they get for these clinic and pharmacies, then I could see a pretty reasonable upside in this company. So I'm still holding my shares. I have 20-ish thousand shares in terms of a disclosure, my perspective. So I was concerned that maybe this would be the conference call that I'd decide, okay, I need to be done with CloudMD. Kind of rode up and down the COVID wave, and maybe it's time to accept my fallibility and not selling during COVID. But I'm going to continue, and as long as they can keep growing over 10%, then I'll probably keep holding on. If the price for sales goes above 3, then I would think of starting to let some shares go. But you need to have a potential for a double, triple, 5 times in order to own a stock like this, and that is there, and I don't see insolvency in the near future. So that's the first thing you look at. So hopefully these comments were helpful to you. If you did, please like the video, consider subscribing. Depending on the feedback, I'll maybe make some more of these videos. Please leave comments, particularly what you think is going to happen in the future. Do you think that the Vision Pros is going to ramp up way faster than I do? Maybe you have a better opinion on what the clinic and pharmacies might get. I know it's 2 times sales, way off base. I didn't put too much effort into researching that part. It was just a reasonable rule of thumb for modeling sort of a non-tech business.